As the ride-sharing giants Uber Technologies and Lyft face a new reality, Google-backed Waymo is expanding into new markets, and General Motors is scrapping its self-driving business unit, Cruise. Autonomous driving technology is revolutionizing the sector, creating both opportunities and challenges for ride-sharing companies. I believe Uber is well positioned to thrive in the long term due to its large scale, diversified business operations, and global presence, making me bullish on its prospects. However, I remain neutral on Lyft's outlook. Waymo's expansion highlights its ambitions for independence, as it plans to test its Jaguar I-Pace all-electric vehicles in Miami starting in early 2025, with ride-hailing expected to be available to riders by 2026. Robotaxis do not pose an existential threat to Uber and Lyft, as leading mobility platforms will play a key role in robotaxi adoption. In fact, hybrid fleets combining human-driven ride-sharing services and robotaxis have higher fleet utilization rates than standalone robotaxi fleets. General Motors has decided to move on from its Cruise driverless ride-hailing service, prioritizing development of advanced driver assistance systems on a path to fully autonomous personal vehicles. This move removes a key downside risk to GM cash flows, but dismantles one of the company's key strategic pillars and differentiators, negatively impacting Uber and Lyft. The consolidation of the autonomous vehicle market may create a bigger moat for Tesla and Waymo, which are unlikely to be capital constrained. As the autonomous driving technology continues to revolutionize the ride-sharing industry, ride-sharing giants Uber Technologies and Lyft are facing a new reality. Google-backed Waymo is expanding into new markets, while General Motors has scrapped its self-driving business unit Cruise. This development creates both opportunities and challenges for ride-sharing companies, and I believe Uber is well positioned to thrive in the long term due to its large-scale, diversified business operations and global presence. In contrast, Lyft's outlook is neutral. Waymo's decision to partner with Move, a mobility platform popular in Africa, instead of a well-established ride-sharing platform like Uber or Lyft, suggests the company is looking to expand its fleet partners and reduce its reliance on leading mobility platforms. As part of its expansion plan, Waymo will test its Jaguar I-Pace all-electric vehicles in Miami starting in early 2025, with ride-hailing expected to be available to riders in Miami by 2026. This move will open doors for a new era of robotaxi commercialization, as Miami will challenge robotaxis with adverse weather conditions on a regular basis. If Waymo succeeds in Miami amid challenging weather conditions, rider trust in robotaxis will be boosted. Despite this, I don't believe robotaxis pose an existential threat to Uber and Lyft, as leading mobility platforms will play a key role in robotaxi adoption. In fact, hybrid fleets that combine human-driven ride-sharing services and robotaxis have higher fleet utilization rates compared to standalone robotaxi fleets. In the long term, robotaxis and human-driven ride-sharing vehicles are likely to coexist. General Motors' decision to move on from its Cruise driverless ride-hailing service also points to a more consolidated autonomous vehicle market. The company will no longer fund Cruise's robotaxi development as it prioritizes development of advanced driver assistance systems on a path to fully autonomous personal vehicles. This move raises questions about the readiness of Cruise AV tech and the future of its partnership with Uber. The firm's analysts view this news negatively for Uber and Lyft, as it points to a more consolidated AV market. While this development may create challenges for Uber and Lyft, I remain bullish on Uber's prospects due to its long-term growth potential. As the ride-sharing giants Uber and Lyft navigate a new reality, I'm bullish on Uber's long-term prospects, but neutral on Lyft's outlook. With Waymo expanding into new markets and General Motors scrapping its self-driving business unit Cruise, autonomous driving technology is revolutionizing the sector, creating both opportunities and challenges. Uber's large-scale, diversified business operations and global presence position it for long-term success, while Waymo's decision to partner with Move instead of a well-established ride-sharing platform like Uber or Lyft suggests the company is looking to expand its fleet partners, reducing its reliance on leading mobility platforms. I believe robotaxis will not push major ride-sharing platforms out of business. Instead, leading mobility platforms like Uber and Lyft will play a key role in robotaxi adoption. Hybrid fleets that combine human driven ride sharing services and robotaxis have higher fleet utilization rates, and in the long term, robotaxis and human driven ride sharing vehicles are likely to coexist. General Motors' decision to discontinue its Cruise robotaxi development and prioritize advanced driver assistance systems on a path to fully autonomous personal vehicles further highlights the challenges of operating and maintaining robotaxi fleets, as well as the significant capital required to scale such networks. While this development may create uncertainty for Uber's AV ambitions, I believe Uber's ride-hailing network will continue to be a valuable asset, allowing the company to finance and integrate AV vehicles onto existing networks with positive economics and user experiences.